Welcome to another video of Wiseman Traders, mentoring the eager to become wise. All I ask is for you to hit that subscription button and give the video a like so you can be up to date with all of our content. I'm Johnny Margarito. This video I'm going to be teaching you guys how to evaluate a company, because when we start we don't know what we're doing when we're looking for investments and trades. So I'm going to be giving you guys some key insights onto the balance sheet. This is so important because a lot of people don't know what they're looking into. They're looking into news, into speculations, hopefully not memes. But the balance sheet is probably the top thing that we need to be looking into when investing, because this is all the numbers, guys. And I'm going to be breaking down all these numbers just to see if a company is cash flow positive, if they could pay their debt, how much debt they have, their earnings per share. We're going to be taking a look at all this stuff, guys, because it's so important when we're considering investing into a company. So I'm going to be giving you guys some a PowerPoint so we could get into all the fundamentals of the balance sheet. So let's get into it, guys. So first things first, where do numbers come from? And number one, that's the balance sheet, which is the total assets, which is the total liabilities plus shareholders' equity. So that's everything that the company is liable for. And next you got your net income, which is your total revenue and gains minus your total expenses and losses. So you want to check out the company's revenue for the past year. You want to check out their quarters, their last performance. And number three is their cash flow. You want to see the operations, the business activities, the investing, what are they doing with that money, if it's going to equipment, plants, what. Financing is the cash flow between business and credit. So these three things is where numbers come from. So let's get into the top 5 financial ratios, which is valuation ratio, a profitability ratio, liquidity ratio, debt ratio, and efficiency ratio. These are the top 5. There's more, but these are the top 5 when looking into financials. So let's take a look at the price to earnings ratio, which is called the PE ratio. This is the company's share price to its earnings per share. So relative value of a company's shares, apples to apples. And the formula is simply the market value per share divided by the earnings per share. So it's how much we're paying per share versus how much they actually make per share. And a healthy ratio is typically under 15 or lower, but this is subjective to the sector that it's in. So the next one is price earnings to growth ratio, which is PEG ratio. This is also a valuation ratio. The PEG ratio is the company's share price to its EPS growth. So this is a relative value of a company's stock value factoring in growth. Now the formula is the price to earnings per share divided by the EPS growth. Now the EPS growth is an estimate, guys. So it's estimating if people are already pricing in future growth to the stock. So that's something to look out for. And a healthy PEG ratio is usually around 1 or lower. But of course that's subjective to the sector. Next, let's get into the price to book ratio, which is the PB ratio. The PB ratio is the company's market cap to its book value. So it compares the cost of a stock to the value of its equity if the company was sold today for some reason. So it's the stocks to the asset value, the market per share price compared to the asset value. And the formula is simple. It's the market per share price divided by the book value per share price. Now the book value is the total assets minus the total liabilities divided by the outstanding shares to come up with that number. So the PB ratio is an important one to be looking out for. And of course a healthy ratio is around 3 or lower, but it all depends on the sector, of course. So the next one is return on assets, which is ROA. It's a profitability ratio. The ROA is how profitable a company is compared to its assets. So it gives an investor an idea as how efficient a company's management is using its assets to generate earnings. So this kind of lets us know as investors, like we're giving you our lemons to the company. It lets us know if they're producing lemonade out of it. So that's how we could look at the ROE ratio. The formula is the net income divided by the total assets. So a healthy ROA ratio is 5% or higher. Alright, so the higher the better for the ROA ratio, because that shows how much the earnings they're generating. So the next one we got return on equity, which is similar but a little bit different. ROE is the measure of efficiency a company is at generating profits. So it gives an investor an idea of the profitability of a company in relations to the shareholders' assets. So the formula is simply the net income divided by the total assets of the company. And this is totally varies by sector because it depends on, well, all these depend on the sector. It depends if they're a small cap, medium cap, or large cap company, as well as what sector they're in. If they're in financials or they're in industrials, that all has to do with it. Again, you would like to see a higher number, more preferable here. Higher number the better for ROE and ROA. Next one we got the current ratio, which is a liquidity ratio, meaning how fast can a company pay off their debt. The current ratio measures the ability to pay short-term obligations or those due within 1 year. It gives an investor an idea how a company can maximize the current assets on its balance sheet to satisfy debt and payables. The formula is the current assets divided by the current liabilities. So a healthy current ratio is usually 1.2 through 2. So it's usually a low number. So next we got the quick ratio. It's another liquidity ratio. The quick ratio measures the company's capacity to pay its current liabilities without needing to sell inventory or getting more financing. So this is considered more conservative than the current ratio. It gives us an indication of how quick they could pay back their debt. And their formula is the cash plus marketable securities plus account receivables divided by the current liabilities. And a healthy quick ratio is always going to be as close as 1 to 1 as much as possible, because it shows us how much cash in hand versus liabilities. So we want to see is 1 to 1 as close as possible. Okay, so next we have debt to equity, which is a debt ratio. The debt to equity ratio is a measure of a company's financial leverage. It's a measure of degree that a company is financing its operations through debt versus wholly owned funds. So the formula is the total liabilities divided by the total shareholders' equity. I'll give you an example right after this, but a healthy debt to equity ratio is ideally 1 to 1 as well. So let's take a look at an example right here. We have company 1 and 2. Company 1 has 100,000 in business loans and only 20,000 in cash in hand. So that gives them a 5 ratio of a debt to equity ratio. And the other company only has 50,000 in business loans and it has 100,000 in cash in hand. So it gives it a 0.5. So meaning it's a low risk company. It's a better investment rather than company 1. Next, we have an efficiency ratio, meaning how efficient they are at producing income. This is an asset turnover. The asset turnover ratio measures the company's ability to use its assets to generate sales revenue. A measure of the degree that a company is financing its operations through debt versus wholly owned funds, meaning what they actually own. So the formula is the total sales divided by the beginning assets plus the ending assets divided by 2. So And of course, for the asset turnover, you want to see the higher ratio as possible because it shows how much they're able to generate sales off of what they sell. And just to give you guys a little example here, we're going to use Walmart, Target, and AT&T and Verizon for their turnover ratios, the asset turnover ratios, and we can see Walmart and Target produce better sales off of what they sell than AT&T and Verizon. So here's a good example right here. Okay, and lastly, I want to show you guys the best website to view the financials and all this information. I use finviz.com. And on this is fantastic. You can see all the daily movers. You have a heat map over here. You can see what's happening with the stock market on the day-to-day basis. But let's take a look at a specific stock. Let's take a look at Apple right away. So look at here, you can see the chart. And you could pay to see intraday, daily, weekly, monthly. But this is not what I'm going into. The best thing that this website is for is to look at all this down here, their financials, to give us all the information. And what I love is that they highlight the green for positive and red for negative, so that helps out so much. So as you can see, the ROA, Apple kills it with producing income. The PE ratio is 32, which is pretty healthy for a tech stock. If you look at other techs, they could be way up there. So 32 is pretty healthy for a tech side of it. And you can see everything that they have. You can even see the employees and all the information we went over, the PEG, the PB ratio, quick ratio, current ratio, the debt. So this website is fantastic, guys. So definitely use it. It's called finviz.com. I highly recommend using this when you're searching companies and considering investing into them. I highly recommend digging deep into this, guys. I hope this video helped you guys. Hope you took some notes so you guys could look at a balance sheet and understand fundamentally what you're looking at now. And I hope you guys could go out there and choose some good solid investments, especially into individual stocks, because it's going to be a good time to pick some individual stocks right now. So use these tips, guys, when looking into a balance sheet. Give my video a like, and let's keep earning and growing together, guys. Let's go.